Hello everyone and welcome back to another episode of the Smart Money Show. My name is Daman Akhtar and usually I'd say, as usual, I'm joined by Ali Suleiman. But today you're stuck with me and me only on the hosting side because Ali's away abroad. He's enjoying some nice time off, but we stay true to our promise of delivering a weekly episode. And as you guys may know as well, it's the last episode of August. So as usual, as per our routine, we're going to deliver our monthly recap episode. And with that, we've got our own very own resident experts. We've got Dylan Ilett for representing equities, and then we've got our newly appointed Wahy, who's heading over our FICC team at the Smart Money Show. So I guess without further ado, how are you guys doing? Dylan, how's your day going?
Yeah, good, thank you. How are you?
I'm all good. What about yourself, Wahy?
Yeah, all good, man. All good, all good.
How's summer going? Dylan, I know you finished up your internship.
Yeah, just finished up last week. Very good experience, a lot of hard work, a lot of insights to the industry that hopefully will start reflecting into the episodes.
Yeah, amazing. And of course, we've seen the effort you've been putting in, like with the Smart Money Show and everything. So it's a well deserved, and I hope you did enjoy the 10 weeks. And of course, Wahy, you've joined us on fairly recently as the head of FICC. How's that been going? You guys have been smashing it with the articles. How's that?
Yeah, no, 100%. It's been a really good experience so far leading my own team. The coverage that we're putting out is
Hmm.
a huge range. We cover a variety of different things. And I look forward to see what the FIC team can bring to the table and going into the
Yeah,
future. Yeah.
amazing. And of course, we are always welcoming anyone who wants to join and try help out. Have a try at writing up some articles, and of course they'll be guided by our very own experts right here. But anyways, of course, it is time for our recap episode, isn't it? So we've got a nice range of topics, and as usual, we start off big, talking about overall economic data such as UK, US. We talk about that, then we dive into different topics, and let's see where it goes. So of course, we're going to start off a bit more open then. So UK economic data. Wahy, I'll let you lead with that. So what's been happening for the past month or so?
Yeah, so I'm gonna go into the little number crunching bits at the moment of what's been going on in the UK in terms of the macro side of
Hmm.
things. So
Yep.
we're looking at GDP right now. It grew 0.3% in Q2, services 0.4%, construction 1.2%, and production went down by 0.3%. And the International Monetary Fund, or the IMF, revised their 2025 growth to 1.2%, which initially was 1.1, so that's a zero point 0.1 change, and they're citing resilient services. Now, from this, we can gather that growth is positive, but it's fragile at the same time. And at the moment, services are carrying the economy. Whilst production is weak, we are reflecting on ongoing industrial stagnation. And even though the IMF has upgraded, it's marginal. It's not a sign of booming momentum at the moment, but it's maybe more to note stability in this picture here. And so the big question I'm asking my team and myself at the moment is, can the UK sustain this going into
Hmm.
Q3, um, given that consumers are under pressure as well? You know, when we look more into the inflation side of things, we see that CPI is currently at 3.8% year on year, and it's been the highest since January 2024. This is driven by airfares, accommodation, restaurants, and a big increase in consumption as well. And obviously, given that August's CPI is due in September, we're expected to close around 4%.
Hmm. Okay, really interesting. And then of course on the side of like the fixed income, the FX markets, current commodities, what's the effect on those markets been with this economic data?
Yeah, sure. So obviously, I go on this later on in the niche topics. I talk
Hmm.
about cable as well and how its effect has been between sterling and dollar. So we'll definitely be covering that a bit later on.
Hmm. Oh, okay, perfect. And then of course, like with the UK now, I guess a leading indicator is of course interest rates as well. So is there anything on that end?
Yeah, sure. So when we talk about interest rates, the Bank of
Hmm.
England cut bank rate to about 4% on the
Hmm.
7th of August. So it's at a 5-4 split. When we look at young long end gilt yields, they surged uh, as it happened anyway. NatWest itself is at a 52 weeks high on the Q2 beat. HSBC lagged on the other end as well. And when we talk about banks as well, Barclays and HSBC exited at net zero banking alliance. So even though the Bank of England's cut was razor thin, it shows that the MPC is split down the middle, and this shows that markets are a lot more cautious. We're expecting a lot fewer cuts going into the rest of 2025.
Yeah, and I think that's one thing that, like, of course, you can get an image from the rate cut itself on what the wider committee is thinking, but then when you get the split and then you look at the who voted on a cut, who voted on just keeping interest rates the same, it does give like a strong picture on, I guess, the direction of the wider UK economy. But of course, another very, very important, or people say more important economy would be the US. And so Dylan, over to you then. So on the US side, what's the most important thing that's happened in August, and then what else has been happening?
Yeah, so a bit of the background on GDP growth. We spoke on that last time, and GDP growth in the US is at 3.3% over the year. And we have had some further estimates of what we're expecting for quarter three. We're talking roughly 3.5% to 4% GDP growth, which has been estimated. So some targets have actually been uplifted. The main talking point at the moment has been inflation, and we've just had announced the personal consumption expenditures index, which is now up at its core at 2.9% over the year. So at core, it obviously excludes things like food and energy, so it's more durable items and house prices. So inflation has risen. And obviously this is something that's providing a lot of conflict in the US from an economic standpoint, because obviously Trump is trying to sort of force a rate cut, and obviously the Fed Chair Jerome Powell is sort of trying to shy away from that. And the main concern is not actually inflation anymore, it's actually the labour market. So there's a multitude of concerns about whether jobs are going to be lost over tariffs. Are these costs obviously being passed on to companies, which means that they have to lay people off? And we have unemployment at a 4.2% rate at the moment, and jobless claims actually decreased this week to 229,000. So there's still optimism for a rate cut. It's just how much we take into account inflation compared to the job market, and whether Jerome Powell thinks that this will actually stimulate the economy, considering obviously the tariff pressures that the US are facing at the moment.
Okay, makes sense. And of course, later on in the episode, we're going to talk more about the FTSE and I guess more relevant, the S&P 500. But to give more of a general overview and maybe pick out a few stocks, how have equities responded then to this news? And are markets still pricing in cuts, or are they still holding back?
So in terms of the inflation rate news we received today, actually markets after trading has slipped off slightly. Today was meant to be one of the best performing days of the years, but actually markets dropped slightly after trading after this news. And there just seems to be quite a lot of conflicting information where people believe that there will be a rate cut, but then obviously there are the opposite opinions that there won't be. So equities have dropped slightly. However, in terms of the overall S&P, we will get into that obviously, but it's actually been performing quite well over this year.
Yeah, and funny enough, now rounding off like both of these topics, we started off with like a bit of, at the start of the year we had the divergence where everyone was aiming for 6,500 on the S&P, so US exceptionism, everything. Everyone was, guns ho with Trump coming into office, and then the UK was a bit on the other side, and then that switched, and then now it seems like it's switching again the other way. So it's or they're both actually kind of on the same page in the sense that these both economies are like in a very wait and see area. But yeah, anyways, so that is us kicking off this episode with the wider macro news. But now it is time to dive into some of the more niche news. So Wahy, now you wanted to talk about BofA, Bank of America's ultra short FX calls. So talked about that. I know that's a lot of jargon for maybe a lot of our viewers. So could you talk to us about that, and then just tell us what it means?
Yeah, sure. So, I mean, FX is currently a big spanner in the works in markets.
Mm-hmm.
And just to explain what ultra short FX calls are, these are
Yep.
essentially trades that target predictable price movements that can last anywhere between, a couple minutes to an hour. And they often sit around benchmarks. If you're talking about London time, we're talking at around like 4 p.m. They have like a London fix, we like to call it in trading terms. And
Mm-hmm.
so from the 26th of August, the Bank of America made 9 calls around the MSCI rebalance, which means that they got 8 out of 9 correct. And these trades, they lasted 15 to 45 minutes. And they essentially exploited the concentrated amount of flow that was happening in the markets as well. Now, the reason why I mentioned this is because we're talking about microstructure here, not macro. And we're exploiting just flows and not fundamentals in this case. And the edge that they've got at the moment is their timing benchmarks. Like I said, the 4 p.m. London fix, where it shows that these flows are predictable. Now, although the accuracy is impressive, these costs and the amount of slippage that also takes part is also very high. So when it comes to the profiting side of things, it's very uncertain in that regard. And we like to call this alpha decay. Alpha decay
Mm-hmm.
essentially just means when other people copy your strategy. And so this therefore leads into my bigger question that I'm gonna leave it open ended, of course. Are investment banks now running like hedge funds in their FX desks?
Mm-hmm.
I think it's something that we should definitely be thinking about. But yeah,
Yeah, no, 100%. It's a niche topic, but yeah, it does make sense on that end. But now of course you did speak about how it's not more fundamentals but more short-term positioning. Could you speak more about that maybe?
yeah. So when we look at fundamentals, we're essentially looking at those macro, those key drivers. We like to call them catalysts in trading as well. What essentially is moving the markets in whatever direction. We like to refer to that as being fundamental. And when we look at flows, we're just looking at essentially how much is being traded at a specific time during the day. And so, like I said, it's more affecting the flow
Mm-hmm.
rather than just purely fundamentals. We wouldn't regard this as a macro story, hence why we definitely call this a niche.
Yeah, yeah, no, that makes 100% sense. But then I guess I know it is a micro story, as you've literally just said. But do you think that there is any wider repercussions of this, or?
Yeah, I mean, look, we're looking at the Bank of America here. We are technically talking macro terms, but like I said, we're looking mainly at the FX desks, which do account for technically a minority in the larger space. I mean, FX trades around $5 to $6 trillion a day, so definitely we're as much as we're seeing Bank of America have this kind of movement, I think plays come from all around the globe from different investment banks, which we can definitely get into as I spoke about previously, HSBC and NatWest as well.
Yeah, yeah, that's amazing. And then now, Dylan, moving on to our next topic. So you mentioned, like at the top of this episode, we spoke about how we're going to talk about the FTSE and the SP 500. So looking at these equity indices and of course the wide effects that were mentioned right at the start of this episode, what has been going on throughout August? And I guess could you tell us the wider story as well throughout this year?
Yeah, of course. So, for reference, we have the S&P 500 up 1.3% roughly over the month. It's still sort of fluctuating as I look at my screen. And we have the FTSE up 0.5%. Roughly over the month, so it's been a positive month. And starting with the S&P, and actually including the FTSE, this has largely been to corporate earnings. We've
Mm-hmm.
seen nearly every single company within the S&P actually report positive earnings, which has obviously sparked this uptick in markets. I believe we're on our fourth consecutive month of positive gains within the S&P. So obviously, considering its slow start to the year, it's actually up just below 10% year to date. So that really shows the recovery we've seen within the S&P 500, and I think it has been due to the cyclical corporate earnings that we have seen. And then the FTSE 100 is actually up 11.2%. And again, this has been mainly followed by a stronger pound compared to dollars. This has also come from a retraction from investment into the US, and obviously investors are seeing these undervalued stocks within the FTSE 100. But something I wanted to point out that I only really came across a couple of weeks ago, and I think it's something that's not spoken about enough. Actually, 10%, the top 10, companies within the FTSE 100 make up 40% of the index. So obviously there's a lot of talk about the S&P and how the Mag 7 make up such a considerable amount, but actually the FTSE 100 is more concentrated than the S&P 500. So it's quite an interesting point there, and these include banks like HSBC. We're also talking AstraZeneca, BP, for large companies. So it's just an interesting side note there. So it's been positive for the two indexes. Again, this is mainly due to corporate earnings, but yeah, just a side note on that for something to people to think about is that actually the FTSE 100 is more concentrated than the S&P.
Okay, I didn't actually know that. I thought because whenever you'd mention the S&P 500, any follow-on news would be more directly related to the Magnificent Seven companies, as you said. But okay, that is interesting. But then I guess this wider trend that's been happening, then, do you think that this is the movement in August is specific to August, or do you think it's going to carry through into September and then Q3, Q4?
I think overall, we'll touch on it slightly more. I think the S&P is a much more sensitive index. It's a more sensitive market, and we'll touch on that slightly with Nvidia. And I think it's entirely dependent on Fed rate decisions. So that's really what's been driving markets, and obviously inflation, obviously only a PCE reading, has obviously dropped markets today. So I think the S&P is entirely more volatile than the FTSE. Do I think it's going to finish in the green over the year? Yes. But I think the FTSE 100 is likely to have a more stable trajectory. I think it will continue to increase. Obviously, that will be depending on what we see in the budget we see in the UK and other economic readings throughout the year. But I think overall it should be a relatively positive year for both the markets.
Yeah, 100%. And I've heard another key word being used a lot when looking at the longer term trajectory of these large indexes, and people say that AI efficiencies is somewhere where there's a lot of potential for value, if you get what I'm saying. So yeah, very, very interesting. So and now moving on to our next topic, talking about, I guess, a very nice macro but also micro news, because Wahy, now talk to us about the harsh the drought crushes. So this is very thick, very commodities. So of course, what's been happening, these droughts have been hitting harvest, and then what impacts are we seeing on specific commodities?
We don't usually discuss agriculture day to day, and I think it's something that we should be speaking about a lot more, since that it is a commodities topic. It's part of FICC as well, which is why I added it in. So as much as I would definitely class it as a niche, it does also count as a macro point as well. And so these what we're looking at here is agricultural commodities depend on weather, and so things like droughts, it will reduce supply as a result, which then leads to, since you've got constrained supply, you've got prices having an upward pressure as well. And so the UK has had the driest springs in decades, meaning that harvests have now come out 2 weeks early. And the biggest crop that's been hit has definitely been vegetables. Cereals are now at roughly 5% below average. And this is potentially the fifth worst harvest in 40 years, which is devastating. Wow. Considering what's been going on right now. We've had reports that this has been the hottest summer in the UK that we've had in a while. And so, when I'm looking at this, it's not just farming in this case. we're looking at a whole macro story here, and essentially a poor harvest means that imports have to also increase. So you're looking at a wider trade deficit in the economy. And now the risks for the second wave of food inflation is very high, but the Bank of England, I think they should definitely be making that as a target, just as they're trying to bring their CPI down as well. And this also does add, political pressures, as you've got households that are essentially feeling these food prices. And when we look at it globally as well, climate volatility is turning agriculture into somewhat of a systematic risk factor as well. So those are points that we do have to think about.
Yeah, no, 100%. And of course, as you said, like this is directly related to the CPI number, because that basket of goods, when you're looking at commodities like grain, like vegetables, of course, the effects will be more significant than they seem, right? But now, of course, you mentioned that it was more systematic, this risk and this issue, but then are markets pricing this in as a short-term issue or more long-term, like a structural, infrastructural issue, maybe?
Yeah, so I haven't got data on that, whether it's going to be long term or short term. But if I was to make an inference on this, I would definitely say it's the long term here. When we're talking about crops harvesting, we're looking at sustainability here. We're looking at what can we price in now to then allow us to look for a better future in terms of agriculture. The worst thing is for us to completely lose harvest, or to have another drought, in a sense where our supply is constrained so much to the point where we have a sort of stagflated sort of agricultural market, if you like. So definitely be looking at long term is the inference that I'd be making there.
Okay, no, yeah, makes complete sense, because of course this isn't really like an issue that could be resolved in the short term either, realistically. So, and even in the long term, to be honest. But anyways, I think we're smashing it today. There's so many topics being covered, and interesting topics to say the least. But now a big name that has been said on our podcast and probably many other podcasts as well is Nvidia. And now, of course, we had their earnings recently. So, and if you're reading the news, you read that there was also a very large deal with the US. So, Dylan, talk to us about that. Now, let's start with the earnings. So, what was the earnings report like, and then what stood out to yourself?
Yeah, so Nvidia announced $46.7 billion in revenue, beating analyst estimates of over 700 million, which was roughly beaten by 6%. And this was actually up 56% over the previous quarter and the previous year. So their revenue has risen by over 50% in the previous year. Now, this is something that really demonstrates, that's going to demonstrate how volatile markets are, because Nvidia actually fell when they announced these earnings. And this was because markets were expecting them to beat earnings by a much stronger number. And obviously, I've spoken before on the podcast how I think markets have changed, especially the US market. I think this is something that people should pay attention to, because now markets are demanding so much more from these AI companies that it will really create an issue one day when they hit expectations or they're slightly below, because these expected figures are colossal figures. It is not a regular thing to expect a company to increase their revenues over 50% over a year, but they are doing it, and investors are still not satisfied. So that was an interesting point I took from it. Obviously, earnings per share, they beat earnings per share at roughly $1.08, which was expected to be $1.04. And then another thing we took away from the Nvidia earnings, so they beat expectations. That's the bottom line of it. But also, one customer contributed 23% to their total revenue this quarter, and two customers contributed nearly 50% of their total revenue this quarter. Now, the 23% accounted for roughly $10.7 billion. So, I mean, we can take quite a educated guess at who that might be, whether it's Amazon, Microsoft, Meta, Apple. And I suppose that provides sort of 2 points to the argument. One, is there a concentration risk in Nvidia's customers and who they're selling to? Or does this show strength that a huge company is doubling down on Nvidia and spending so much on their GPU chips instead of going elsewhere? So they beat earnings, however, markets were still not satisfied with it. And obviously, we have 50% of their revenue coming from 2 sole customers. So 2 interesting points to take away from the earnings.
100%. And I guess to a certain extent, it does justify the sensitivity, because if you've got a company that is so heavily reliant on specific, I guess, a specific customer base, like 2 or 3 customers, then I'd see why markets do see as sensitive. But then this wider story of like having such a high earnings growth but being marginally lower than the predicted, causing like considerable effects on price, that isn't really like for Nvidia specifically. That's happened before as well in the past. Like I think I remember like an episode we were filming, a recap episode last year, and it was the same thing. So Nvidia, they like absolutely smashed earnings, but because it was just marginally lower than what markets predicted, the stock just went through the floor, which is amazing. Like it is amazing, and it does show a lot. But then of course the second part to this topic is the deal with the US. Now, could you talk to us about that, and then this whole growth story of Nvidia? Now, how will this deal tie into that?
Yeah, of course. So for a bit of background, obviously there was a ban on chip sales to China, and Nvidia actually excluded Chinese sales from its Q3 guidance. So midway through the month, we had the president of the United States, Donald Trump, the CEO of Nvidia, and the CEO of AMD in a negotiation of effectively, China's one of their large markets. China are getting very big on AI. We want to sell to them. You're not allowing us to. How can we make this happen? So effectively, Donald Trump said, you can sell to China now, but you need to give us 15% of the revenues you receive from that. And to be honest, both of the companies were very happy with this, because obviously China is such a growing market. It would be better just to give up some of that revenue than not to have any of it at all. This is the deal that's basically gone on. This means that Nvidia can now export their H20 chips, and AMD can export their MI360 chips to Chinese AI firms and other technology firms. So obviously there's been a criticism on Trump whether he's been too harsh on these companies and he should enable them to make these sales, because obviously this is bringing in revenue for the US. However, also from a strategic standpoint, he doesn't want China to become the next AI economy. Mm-hmm. He wants US to lead that. So you can understand his sort of protectionism process that he's going through. But then also, is it going to stunt the growth of Nvidia and AMD? And obviously he's clearly turned back on what he went with beforehand, and he's enabled this deal, which obviously means positive things for Nvidia. It just means they have to take a slight haircut on their revenue from China.
But I mean, as you said, like for companies that are literally growing 40-50% at a time in revenue, like even making such a sacrifice, just that whole having access to that wider Chinese market, especially in the AI space, it makes sense. But then again, I guess Trump's very dual mandated in this scenario, because of course he's got the strategic standpoint, but then of course he does need some sort of, I guess he's gaining some revenue, some tax revenue, but then he's got many issues looming over, which puts him in an awkward position strategically, if that makes sense. But anyways, I am rambling. So I think we should move on to the next topic before the viewers get too bored. So now, one very, very common and like probably the most important fixed income or FICC asset out there, which is fixed income. Now, Wahy, of course, that being your niche. Talk to us about 30-year gilts now, and the whole story dating back to 1998. So what's been happening now?
Yeah, so I mean, I think it's important to break down what gilts actually are before we discuss
Hmm.
anything further. And so gilts are a UK government bond. Now think of bonds like an IOU from the government to us, to the general public. It could be to investors. It could be to anyone that wants an IOU from the government itself. That's what we're talking about when we speak about bonds. And so the 30-year gilts are long-term debt that we're looking at here, and their yields reflect long-term inflation trends, and whether or not we think it's physically credible as well. And obviously, 30-year yields, they've currently been at a high. The peak it's ever been at is at 5.64%, which was dated back in 1998. It's currently sat at 5.58%. And this is driven by quantitative tightening, which we'll get into on
Hmm.
in the next fixed story. So we'll definitely be covering that as well. And also we're looking here about inflation fears, and the issuance of DMOs as well. Now, the big story in August here is that long-term borrowing costs have decided to explode, given that the Bank of England has priced in their cuts as well. It shows the disconnect between policy at the front versus policy from the back end, and you've got physical flexibility, which has gone as debt service costs are surging as a result of this. Now, we're looking here at the mini budget. And it's not essentially the wider picture,
Hmm.
but it still tells the same message that markets are demanding a premium to hold gilts. And when we look at it from an external point of view here, you're looking at mortgages, corporates, and the state. This means higher for longer borrowing costs, regardless of what the Bank of England decide to do. So given that we've got this high, um, I do think that we might potentially reach 1998 levels, or potentially even surge past it, given our current state of the economy.
Hmm. And then, of course, a lot of people they look at gilts as a representative of the health of an economy. So, how does this narrative like fit in with the broader story of like rate cuts and inflation?
I think when we boil it down, we're here looking at demand and supply, to
Hmm.
to a great extent. How are investors seeing gilts? Now, we typically tend to see gilts as some sort of a safe haven asset, and in more of like a risk off environment, investors do like to pick up gilts as part of their fixed income, within their portfolios. So I think when we look at demand and supply, it does reflect the economy to a greater extent. When we're looking at interest rates, because what tends to happen is that interest rates and yields have some sort of an inverse relationship here. So once we notice that pattern, then we can definitely see that, through bond issuance, through gilts, especially long-term debt, you can then see how the economy is playing out as a result. It won't be 100% perfect. Nothing is in markets, because if that was the case, then I guess everyone would be rich and living in the Bahamas right now. Do you know what I mean? But yeah, we can definitely tell some sort of a story, given that bond prices and yields are reflected into markets.
But then, do you think this, I guess, safe haven status that, uh, not even gilts, but just bonds in general. So I know there's a different story with U.S. bonds, but then do you think that's gonna stay consistent, or like do we see a stronger shift towards maybe equities? I mean, Dylan, you can jump in on that, and if you want.
I mean, obviously, uh, I think that it depends. It really does
Hmm.
depend. It's a really good question that you've asked, actually. And I spoke about this previously, and I always keep on speaking about this. It depends on the environment of the market. Are investors looking at being risk on or risk off? We always fall back
Hmm.
on safe haven assets like gold, like some equity positions as well, like the S&P, the FTSE. Obviously, Dylan can add if he wishes to as well. But when we look at bond issuance here as well, I do think that it's not a long term thing. There's no definite answer is what I'm trying to say here. You may see investors shift their sentiment going over to gold, or maybe even those index funds as well. I think
Hmm.
at the end of the day, it depends on obviously what investors are more attracted to, and currently yields. from gilts are at a crazy high. So to them, um, by convention, they will just see that as a higher point of return, which is why that's currently the forefront of fixed income at the moment. Well, for the UK.
Dylan, now just posing a quick question onto you before we move on to your next topic. Do you think to a certain extent like these large indexes such as the S&P and the FTSE and maybe some of the European indexes as well, can they be seen as safe haven assets?
I think they are seen as probably safe haven for equities, in a sense that you buy into the S&P, you have 500 shares within one specific stock holding, which obviously is meant to be seen, obviously from a diversification standpoint, that's extremely low risk. But obviously, as we've said before, due to concentration risk, it's no longer the case. It's more like you're buying into a considerable amount of 7 companies or 10. So I don't think they should be seen as safe haven at all. And I think equity investors understand that, and they wouldn't expect anything from equities to be entirely safe, because obviously there's a risk premium on equities that we try to achieve above the risk-free rate, which obviously we normally derive from like gilt yields or SONIA, for example. So I don't think they should be seen as safe haven, nor do I think they ever have been.
I've got a question actually for Dylan. Now that we're on this topic, so when we're looking at retail investors, then we're talking about the average person that has a bit of money in their savings, and they decide to put money into an index fund. How would you then go about them thinking that index funds like the S&P, like the FTSE, are safe havens in their eyes?
So you're saying if they think they're safe havens, or
Yeah, exactly. Because I think there's some sort of like narrative that everyone sort of believes that, oh, if you have a bit of savings, you have to put it in the S&P, put it into index funds. Because I think by convention they do see it as safe haven. So how would you go about that then?
I think in a sense of seeing it as a safe haven, people see it from a inflation standpoint, and obviously we saw like index ETF inflows absolutely skyrocket during the time that we had up to 10% inflation, because obviously we're not seeing that with fixed income at that amount at that time, and obviously with the S&P annualized return of roughly 12% over the last 70 years, equities are viewed as inflation beaters, but obviously that's not always the case. So I think from that standpoint, a retail investor putting into the S&P is generally just a case of people saying, if you have a savings account at like 3.5% AER and you put it into the S&P, you can achieve more returns. But I do agree. I do think there's a lot of misinformation for retail investors about where to place their income, and index funds aren't like the S&P isn't the most diversified index. Actually, the most diversified index would be the MSCI World. So I think it's more a case of popularity and a case of trends. And I think because you hear the S&P so often, that's why retail investors that don't have the knowledge or the experience obviously will place their capital into those indexes. But I don't think it is a safe haven asset at all. And I think there's a lot of information for retail investors, definitely.
Yeah, because especially with I guess the rise of retail investing as well, like you can easily just download an app on your phone and then just uh, buy buy shares of different companies. But then, like from a retail standpoint, not many people are talking about other assets like um like gold, I guess, but like more treasury fixed income assets. It's not a discussed topic. It's very niche to like the people who are well versed in the finance sector. But anyways, I think this is now time to move on to the next topic. Dylan, we are staying with you, so sorry you have been bombarded for the past like 10 minutes, but it's actually not 10 minutes. But anyways, so let's talk about China's rally on the other side of the globe. So what's been happening in Chinese markets, and then what's been the trigger behind what's happening?
Yeah, so the mainland index for China, the Shanghai Composite, is actually up nearly 20% this year. And it's been driven by a few things. So first of all, the fact that interest rates are lowering in China, and individuals had quite a lot of savings. And now these savings are being pushed into Chinese companies, which is obviously a good sign to the index. And in addition, obviously there's a lot of Chinese companies that are competing with the West and in some ways outperforming. So, for example, we had Amina, one of the interns in equities, talk about BYD and Tesla, the competition on that front. And obviously we know that China excel in cheap manufacturing, and they ship their products across the globe. So there are companies in China that obviously are performing well. But actually, a statistic here, we had over 23% of Chinese companies reporting a loss from January to June.
Okay.
However, we've seen the index increase over 20%. So normally I like to have an explanation of what is going on and why X, Y, and Z is happening. But I feel like almost for the first time, there isn't a clear explanation to this. I was reading an article from The Economist and an analyst from HSBC and said, this is effectively out of this world. Why is the index increasing at such a fast pace? And we have mixed signals from banks. So, for example, Goldman Sachs, they raised its target for the Shanghai Composite. We have JP Morgan slightly more bearish on that front. So, again, it's been really mixed signals as to why this sudden rush and rally is happening. Is it because it's perceived that China are winning in a trade war over the US? Is it a diversification away from the US? Is it purely just because there's a lot of savings in the Chinese retail market that are now being flooded into the market? Is it strong company performance? But obviously that's counteracted by many Chinese companies reporting a loss. Is it a case of the top 10 companies in China outperforming and we're seeing another case of concentration risk? There's so many questions, and as of right now, there's no clear answers. But effectively, what we've taken away is the Chinese stock market is rallying, and it doesn't seem like it's going to stop anytime soon.
I guess the overall trajectory can be seen, but then an explanation. I was going to try put out some questions on you, but then realistically, it just doesn't really make sense. And like as you mentioned, these different banks are all in like mixed positions. So yeah, it is a bit of an awkward situation, but yeah, I think to move on to the next topic then, talking about the GBP, so sterling, and then the dollar itself. So Wahy, of course, this being FX. So what's been happening with sterling, with the dollar, and then what have been the drivers behind these actions?
Yeah, so just a quick note before we delve into this topic. If I mention cable, just know that that's sterling being compared with the dollar. So just to make it easier, I'm going to be discussing cable in this situation. And so from the 27th of August, we saw that cable fell 0.33% to the 134 handle, which is still 1.5% as a gain for this month. However, sterling's August as a whole, we like to call it a tale of two halves. It was strong early, but we had a pullback quite late into the month. And I think this is due to the fact that we've had sticky inflation in the UK, which actually supports sterling in this regard. But and even though you've got the Bank of England's 5-4 split cut, it sends out a mixed signal here that maybe we could be cautious, but also a bit too dovish at the same time. And so when we look at corporates and investors here, this is the perfect time. Well, in theory, the perfect time to hedge their FS exposure. Now, from our point of view here at the FICC team, we do think that investors could be, combining a mixture between G10 and emerging markets at the same time. G10 being your global top 10 currencies that are traded in the world, and emerging markets being, your exotics, your major and your minor pairs as well. Obviously, we spoke briefly about the fact that gilts are quite attractive to investors right now, given the surge in their yield. And you could also definitely be looking at FX investors, anyone that's holding long term or short term for that matter, to be moving out and hedging into those positions as well.
Okay, and then so looking forward, then I know you've touched on it, but where do you see these two currencies heading then?
Yeah, look, we've had, like I said, a sticky inflation reading here in the
Hmm.
UK. And I do think that when you look at it from like a holistic point of view, um, I think that we could definitely be moving more into, US assets. Again, we could talk about those safe havens, but I think, in my opinion, when we look at FX, I think investors are looking to take a more riskier approach to their portfolios. Which is why I mentioned about the exotic and the major minor pairs in emerging markets. So you could definitely be seeing more diversification, given that there's uncertainty in the UK right now, with what's been going on. And so, naturally, by convention, in that case, investors would be moving out into those other areas as we spoke about.
Hmm. Okay, yeah, no, but then I think this is a perfect pivot onto like the next topic, which Dylan wanted to speak about, is emerging markets for favoritism. So, of course, we spoke about China briefly as well, in a different topic. But then talking about the wider, like these emerging markets, then are they seeing some favoritism? And then like what is driving this shift towards them? Dylan.
Yeah, so mentioning Bank of America again, they announced a recent poll that basically showed that fund managers are holding 37% more emerging market equities than they usually do, which is actually the highest point in the last two
Hmm.
years. And obviously, China is a large factor of this. But also, there's been quite a few trends that have sort of steered investors away from Western markets to take a look at emerging markets. And for example, we have seen the dollar decline in value roughly 10% to a lot of the emerging market currencies, which obviously has made it more attractive to then invest into those economies. Also, from a valuation standpoint, there's consistent concerns about valuations in the US market and even in other European markets. Obviously, the FTSE is relatively undervalued. But just some data here. So, the MSCI Emerging Markets Index is at a 40% discount to developed markets on a price to book ratio, which is significantly higher than the 20-year average of 17%. So effectively, what we are seeing here is a much larger discount slash undervaluation than we have seen over the past 20 years. And I think that really, really reflects what we are seeing with the S&P 500, where the past 20 years have been exceptional for that specific index. So what's happened is I think that we've seen investors move away from emerging markets, obviously deploy their capital into the S&P 500, and then over time what we've seen is a much steeper discount. And obviously there's other issues that we've seen in emerging markets as well. They're more volatile. Trade is more of a concern in these emerging markets. They might not have the bargaining power. Currency fluctuations, obviously the currencies in emerging markets are typically more volatile. But at the end of the day, these economies are producing more growth than Western economies. So, for example, the MSCI index is up roughly 13.5% year to date. That's beating the FTSE 100, that's beating the Euro Stocks Index, and that is beating the S&P 500. So there is growth there. It's perceived as higher risk. Obviously, investors have clearly ignored emerging markets for some time now, and they're starting to realise where they can diverse away from these more developed markets. And obviously, China is an example of that. We've seen a lot of growth in India, we see a lot of growth in Nigeria, in Singapore. So I think this is a trend that's likely to continue. I believe emerging markets has a place in nearly every single portfolio, and I think it does provide that good diversification and growth opportunity. And I think that fund managers are starting to agree with that. So, for example, we've seen in quarter two of 2025, £2.7 billion of ETF inflows into emerging market indexes. So that's really just demonstrating the popularity that we are seeing in emerging markets. And as I said, I believe it's likely to continue.
Okay, and it kind of seems like the stories is like investors are like ping pong in between, the US and the West and then the emerging markets. But yeah, and of course, as you said, that them being more heavily discounted will, in essence, make the risk lower, if that makes sense. But I know you mentioned a few specific regions, but then could you talk more about like specific regions within emerging markets, and like why do you think specific regions which you find the most interesting right now, and why?
I quite like what India are doing. They are becoming very focused on tech. They're producing a lot of tech hubs, and obviously they are quite a high exporting country. As is Nigeria. Actually, there's a lot of development in Lagos, and they're producing tech hubs. And also they're typically known for being an agricultural nation,
Yep.
but they're introducing things again like agri-tech. That's effectively making their crops more sustainable in terms of how much they yield, and also making the process faster, and they are producing more jobs. And obviously we've seen a lot with Nigeria in crypto markets, where obviously a lot of currencies in these regions aren't as developed, and there's considerations of how they can obviously implement a structured banking system. And there's a lot of talks of using crypto on that front, which obviously means hopefully there should be some significant growth. And if they can pioneer in that front by becoming a country that uses crypto solely for its banking system, it would be an interesting point of view to see. But I suppose they're two key nations that I've been taking a look at in terms of emerging markets.
Yeah, and then I guess looking back at the topic itself of just emerging markets itself, and this like conversation I guess we've been having subconsciously throughout this episode of like an asset being safe haven, and it being, I guess, the risk levels, a kind of like a wider narrative does seem to be playing itself out, doesn't it? But anyways, we are on to the last topic of this episode. There's been just so many different topics, because to be genuinely honest, I've been out of like commercial news for like a good couple of weeks now, so it's been a nice refresher. Of course, I did some research before this episode, but it has been great. So much insight from the both of you. But of course, Wahy, now we've got your last topic you wanted to talk about, and you've mentioned this earlier on in the episode as well. And talk to us about the Bank of England's quantitative tightening. Now, what's been happening? 10-year yields. What's the effect on those? So yeah, go on.
As I said previously, we spoke briefly about QT, quantitative tightening. Now it's time to break this down as well. And this is essentially where the central bank reduces their balance sheet, which as a result leads to a drain in their liquidity, and further impact their yields by having an upward pressure on them as well. And so the Bank of England raised the QT yield impact to 15 to 25 bips. Previously, it was 10 to 20. And as a result of this, gilt yields are now up 325 basis points since 2022, despite the policy cuts. And so the total QT unwind is around $250 billion. And I guess the talking points here we can mention is that QT is now a front and center policy tool. It's not the background noise. And I don't think it will ever be, given the fact that, rates are as cut, QT leads to higher yields. And so even though these two things are happening, they kind of pull. I think they kind of pull the policies in two different directions here. And this as a result means that the financial conditions are tighter than the bank rate may suggest. And in terms of markets here, because that's very important, we're looking at how the market's going to react to this sort of information. Curve dynamics, as we spoke about in the previous episode as well. So if anyone's interested in listening to curve dynamics, that's also a point that we made. But curve dynamics in this aspect are more important in the headline, given what's been happening. And the message that I think we should be taking away from this is that QT is just as powerful as rates in terms of shaping the UK financial conditions. And I think that instead of making something a macro policy or just a policy that the government do, I think it should just be important as the UK setting its rates when it comes to whether or not we're going to price in rate cuts, be dovish on a stance, or be bearish in market sentiment in that aspect as well.
And of course, yeah, the subsequent effects on markets are more or self-explanatory, aren't they? So, but yeah, I mean, that has been amazing. We've just covered so many different topics, and like, of course, August has played out now. September, you know, the rest of this year, the targets that have been set out, is there going to be any more actions from Trump or any other deals being made that we need to cover? So I think that is something that we will be discussing in the future episodes. But that has been the 22nd episode and our August recap episode of the Smart Money Show. If you haven't already, please like and subscribe and share these videos to your friends and any of your peers who are interested in the finance space. We're also hiring for our teams in equities, crypto, writing and journalism, and just all of our wider teams, which you can check out on our website. You can check our Meet the Team page. And if there's anything that you're interested in helping out, then please feel free to reach out to any of us. We'll love to accommodate your request. But apart from that, it's been great. Thank you so much, Dylan and Wahy. And yeah, we'll see you guys in the next one.